As Dominic pointed out, the economy is not helping the investing picture. And Joe, when Dom was speaking, I saw you kind of shaking your head to the side. What stood out for you?
Well, what we're seeing is that, and I'm sure it's going to be a shock that an economist is going to say that fundamental data is going to win out, but the economic data just hasn't been good. It really hasn't been good since the middle of May, and the economy has just hit that invisible wall. What we're going to be looking at this week is housing data. That's going to, and that, for all intents and purposes, is the major headwind to a recovery. The NAHB's housing index this morning, you know, what stood out there for me was that traffic is down. And if you look at how low mortgage rates are, I mean, I got a call on Friday offering to refi my home at 4.49%, 30-year fixed. If we can't get people into homes right now, if we can't get them financed, I mean, are we ever going to, is the question you start asking. We've got a huge supply of homes on the market. Mortgage rates are low. The mortgage spread, which is the sort of the 10-year Fannie Mae minus the 10-year Treasury, it's narrowed.
But the credit markets are still not thawed, because what we're saying is people who had good credit before this crisis fell on hard times, and now the credit requirements are so stringent they can't get a mortgage even with rates this low.
Well, I think it's not only that, it's that the policy that the Obama administration put in fundamentally distorted the housing market.
How so?
And now we're paying that. It pulled forward all the demand for new home purchases and refinancing to the point where, if we look at that MBA mortgage index, which we get every week on Wednesday, refinancing activity is actually falling even though we're at these historically low rates. These are things that fundamentally shouldn't be happening right now, and that's why we've got this increased concern over a double dip or another recession.